All right, so before we dive deep into the next session, which is about identifying market structure and how we can use that as a confluence into our trades, there were two more things I did want to mention about these candlesticks, which are called engulfing candles. So the bigger the volume of the candle you typically see, that means the stronger the move is, the more buyers there are or sellers, vice versa, depending on whether it's a bearish or bullish candlestick. So when you see candles that are extremely big moves like this shows there is a lot of volume. First of all, volume down here, there's a lot of volume and momentum pushing price upwards, which is what is basically telling you that price has very strong momentum to the upside. And until sellers defend their area, price is going to continue up. So again, you want to mainly focus on these big candles, not necessarily these smaller candles, right? These big candles are things that tell us a lot more information than these smaller candles. A lot of these smaller candles can be signs of noise. We want to focus on these big candles and as well as the price action wicks along with them. So again, these big wicks or these big candles are extremely important. And another thing I want to talk about is an engulfing candle, which is when a previous candle engulfs or a future candle engulfs the previous candle. For example, this right here would be considered a bearish engulfing candle. This bearish candle right here has had a body close or body size way bigger than the previous candle right here. So that is a bearish engulfing candle, especially this candle. The second candle right here, with this much momentum, has engulfed the past three candles right here. This shows very strong selling momentum. Again, vice versa, if it is a bullish candle that is very or much bigger than the previous, bearish candle. So that's just something else you want to keep in mind, the size of these candles, as they do also tell you a lot of information about price action. So that's something you guys just want to take into consideration, in my opinion. And yeah, that's going to be it for, I think, candlesticks, honestly. There isn't too much you guys need to know about candlesticks aside from being able to read them in certain key areas. Like, for example, if I draw this area right here, this could be adding a supply. Tons of sellers here. These candles tell me a lot of information about sellers defending this area and us pushing down. That's it. That's the gist of it. But we are in this section, obviously, going to be talking about market structure. So for market structure, if you're day trading or swinging, this depends on a lot. That would depend on what time frame you're going to be utilizing for market structure. Now, me personally, let's go on something else that doesn't have extended pre-market. So it's not like a mess. We can go on, let's see. Let's go on oil, okay? Doesn't matter what you're on. Focus and analyze on the asset you're going to be focusing on trading. Depending on your swing trading or if you're day trading or scalping will depend on what time frame you're using. For me, for the sake of this course, I am mostly a scalper and day trader. So that means I'm going to be analyzing starting on the 4-hour chart. So when identifying market structure, we want to look at, is price going up or is price going down? And one easy way to identify this is if price is going from the left side of your screen to the right side, that means price is going up. If price is going from the top left side to the right bottom right side of your screen, it's going down. That's the common, easiest way to identify market structure. Okay, so when I talk about market structure, what am I really talking about? Well, what I'm really talking about is higher lows and higher lows and higher highs, or lower lows and lower highs. So let's draw a market structure real quick before we even look at these candles real quick. Let me explain to you guys market structure. So how markets typically move. This is in the most ideal situation. In the markets, nothing is perfect. So market structure is going to be a little bit more messy and choppy and harder to read with these actual candles, but this is the gist of how market structure is going to work. Market structure moves in higher highs and higher lows when it's bullish. So bullish market structure will be, for example, like this, where we are making higher highs and higher lows. And these are considered swing points. So I'm going to draw this out real quick. This is considered a bullish trend, bullish market structure. We are making higher highs and higher lows, which I'll circle right here. So we start off with price right here. We have price going to, let me just stay in drawing mode real quick. Is this it? Yep. Okay, so we have a swing high. So these swing points are basically inflection points that are crucial that make these big moves, okay? And depending on time frame will depend on where these swing points are. So we see a big move right here. This is a swing point right here. This is also a swing point right here. Especially these are swing points of market structure. So these are areas you want to be looking at. These are swing points. And that will be the biggest high. Now, looking at these swing points will tell us what market structure is trying to tell us in terms of bias of where price is moving. So price currently is in an uptrend, obviously, going from the bottom left of our screen to the top right. That's the easiest way for beginners to understand. Prices going up. Now these are going to be represented by candlesticks, but you can even switch to a line graph to make it look simpler for beginners starting off. But of course, it's better to get advanced and start learning how to properly read these candlesticks. But nonetheless, this is bullish market structure right here. Higher highs and higher lows. And how can we identify them? Well, we can look at it here. We have so this is the previous point, okay? We have a higher high right here we can mention. So I'm going to put HH, this stands for higher high. We have a higher high here. Oops, we have a higher high here. And then here it will be considered a higher low. Okay, now the trend just started, so we can't really identify these as well. But once we get up here, we will be able to identify this. So higher high, this is the previous high point of price. Previous highest low point of price. This means price is moving up. Now, what would this point be? What would this inflection point be considered? This would be considered a new higher high, which means we are continuing in a bullish market structure. How do I know this? Well, this high right here, this point, is higher than this previous high that we made. And for it to be considered a high, it has to be a strong move, first of all. It has to be a significant move down to be considered a higher high. So this right here is a higher high because this high is higher than this high. Very common sense right here. So that's how you identify higher highs and higher lows. What would this be? Well, higher low. Because this low here is higher than the previous low we made. Previous low was around $84. Previous high, next high is around, next higher low is around $89. We are creating higher highs and higher lows right here. This shows we are in a bullish market structure, okay? And another way you can easily identify this is, first of all, actually I'm going to identify that later, but this is higher highs and higher lows. Again, this would be a higher high, higher low, and finally we have a high right here. Now let's identify what a bearish structure, market structure is. Let me just actually write this out real quick. This is a bullish structure. Bullish structure of price. This is considered bullish structure. Bullish price action. This is not the cleanest chart, but you guys get the gist. Now, what is a bearish structure, which means we're going down. Bear means going down. Well, we're making higher lows and lower lows. It's that simple. Don't overcomplicate market structure. It's very simple. So, what can we see? We have a high here. Let's say actually, in fact, let's do this. Price reached this area right here, this level, and we shifted from a, I'm gonna delete this and move this all the way here. This is gonna be very easy to look at. We are making higher lows, or lower highs and lower lows. Okay, that's good. Lower lows and lower highs. So we have reached this key level right here that has a lot of selling demand, or selling right here. And we have shifted into a bearish structure. I'll explain how you guys notice we've shifted in bearish structure. But right here, as you can see, we have what do we call these? Inflection points. Again, inflection points of the market. These are swing points. You guys can name them whatever you want. They all mean the same thing as long as you understand the concept. This right here is going to be the highest high we've had so far. What would this point be here actually? This would be considered a lower low. Why? I'll explain real fast how you can identify this real quick. It's actually very, very simple, but let's first mark out this market structure real quick. What would this be right here? If this was the previous high, what would this swing point be? This would be a lower high. Price is lower than the previous high swing point. This, lower low. Now you guys are finally starting to get it. Lower high. Lower low. I'm just going to copy and paste this. Lower high. And finally, we have the full on lowest point in price right here. We have the lowest point in price. So as you can see, we have this price range right here. Major price range between $99 and $79. This is the range. This is what I call a range of price. We are ranging within this area in price. This, I'm going to name this bearish structure. Okay, this is when we are going down. And what this tells us here is when we are in a bullish structure like this, on the left side, we want to be playing demand zones. We want to be playing price up. We have a bias of following the trend and playing price up. Whenever price gets to a cheap, fair price, we want to be playing price up. So we want to be playing calls if we're doing stocks, and we want to be playing longs if we're doing Forex, okay? It's very simple. And when we're in the bear structure, what do you think we should be doing? We should be looking for the best shorting opportunities. We should be playing puts or we playing shorts. Now, again, there are, of course, opportunities for us to play, upside during a downtrend. But the upside moves are a lot lower confluence, a lot less likely to happen, and a lot smaller moves. We want to be catching big, high risk reward A+ setups. So we want to be following the trend most of the time. So that's how it works right here, higher highs and higher lows. Now, how do you know? People ask us, how do we know when we have broken market structure? So this is what we call a break of structure. This is what I call it, a break of structure. People call this all sorts of things on the internet. We're calling this a break of structure to keep it very simple. You just need to understand the concept. No one cares what you name it. This concept called a break of structure. Now, how do we know when the trend is shifting from an uptrend to a downtrend? Well, we know this when we have a break of structure. How do we know when we have a break of structure? Well, that's when first we have to identify these higher highs and higher lows, first of all. That's why it's important to understand the logics of how the market moves. Market moves in higher highs and higher lows, or lower highs and lower lows. This is the previous higher low. Price reaches the highest price point right here, rejects, strong rejection, and when we break this higher low right here, that is considered a break of structure. So this right here is considered a break of structure right here. I'm gonna draw this out real quick. Once we break below this point right here, the swing point, this higher low, we have officially created a break of structure going into a bear trend. Now, sometimes there are fake outs that occur where it breaks barely and it comes right back up bullish. There's nothing you can do in that situation. Market is not always perfect, and there's so many other aspects that influence what you're seeing on a chart, like the source and broker. There's a lot of things. So don't worry about fake outs. They're going to happen and you're just going to have to accept the loss. But we know in the long run, we are very, very profitable. So losses are just part of the game. That's what they call it. Straight up, just losses part of the game. We minimize losses, maximize wins, maximize win rate, and we win. So once we break below this previous higher low, once we identify this higher low, first of all, previous higher low, we then want to wait for a break of structure. Once we break this higher low point and have a candle closure. This is extremely important to avoid fake outs. We need a candle that closes below this area. We need to have a candle that closes below this area, this level right here, this previous candle right here. For example, if we're looking at candles, this would be a candle, this would be a candle right here, bearish candle closing down. We need to have a bearish candle that closes with a body below this level. We cannot have what we call a fake out, which is where most commonly you see a wick at this level. We need a body close up below this level for a strong confirmation we are going downwards. Otherwise, if you see a wick, most likely it is fake out, collecting orders, and we continue pushing back up. So body close below this level is considered a break of structure, and that's when we start forming lower lows and lower highs. As you guys can see right here, price is following natural market structure. We're creating lower lows here. Once we break the structure, lower lows, and then we come back up here for a lower high, and then we continue basically the bear structure. Very, very simple. That you guys just want to keep this ingrained in your brain when you're looking at market price action, because it's definitely important to follow the trend and understand where you should be playing. Now, usually what happens is for these lower highs, when we break structure, is rather than having a lower high probably all the way up here, very unlikely, we will typically retest this level we have broken. Okay. Now, this is what we call a break and retest. This is another key term you guys want to know about. Very important. Called a break and retest. This doesn't work perfect all the time, but most of the times this is how price works. Once we break it below a certain key area or key level, we then typically, price will retest this area. Price will typically retest the level that we broke. So we broke this level right here. Price will typically retest this level here before pushing back down. Now, what happens in fake outs is price actually retests this level, but rather than retesting it, price breaks through this level and then we continue pushing up. So that's not what you want to see. You want to see price retest this level and push down. Okay, so that will show us a clear, strong indicator that we are moving back down. Otherwise, if price is opening or closing way above this level that we broke and continuing up, that's not a good sign. So most people do have their stop losses just right, basically, right above the previous level we broke. So that is the gist of market structure right here. Very simple concept. You guys just want to, again, ingrain in your brain. Now, if you want to see this market structure clear, you can always switch to a line graph, like I mentioned. you see higher highs and higher lows. Like look at here. I clearly see, what do you see right here? Clearly, I see a break of structure right here. Break of structure, we can consider this a swing point or this as well. We have broken this swing point right here, let's say for example, and then look, we retested this level and we continue going down. We went from bullish to bearish. Very simple. But you guys can mess around and get familiar with market structure. Personally, I would recommend continue learning with candles because that's how price action typically moves. And you want to be familiar with candlesticks because they give more information, actually a lot more information than what these line graphs tell you. So that is something you want to understand. All right, so that's going to be basically the gist of market structure. And from this lesson, you learn market structure, higher highs, higher lows, how to identify them. You learn what a break of structure is, and as well as what a break and retest is. So after learning all this, once you apply these concepts, you want to backtest and go on the graph and personally identify these areas. For example, right here, I can identify once we break below this swing low right here, we are going bearish. You see, we did go bearish, but we did not go bearish for long. Why? Because this is a 4-hour time frame. Again, we want to look at the higher time frame. There's so many other things you got to look at, but market structure is the general gist of how the market moves. So that's going to be it for this lesson. And for the next lesson, I'm going to go deeper in depth into many other technical things you guys should be looking at when it comes to price action.